Hi, I'm Jim Jubak, and welcome to my YouTube video for September 30th. It's the last day of September, which is why I'm wearing a shirt with long sleeves. No, I'm staying in shorts until hell freezes over or it gets really cold, one or the other. So anyway, I think we're officially into fall, which is not a reason why stocks are going down, but hey, stocks are going down. So anyway, if you want to see more of my stuff, you can go to my free site, jubakpicks.com. That's got 3 portfolios and some portion of the posts that I put up on my paid site, which has got everything. That's jubakahem.com, also down below. And that's got 6 portfolios instead of 3. Does some options stuff, some ETF stuff that I don't do on the regular site. In case you're really dying to read more, please read more. The title today is October Volatility, You Bet, especially for technology stocks. September came through with its track record intact. September is the worst performing month of the year. It shows since 1950, it's on average, the decline is about 0.4%. So we're not talking about a huge down month, but it looks like unless there's a huge reversal today, we're going to wind up in the red for September again. It'll be the first down month since January. We're not talking about a big drop. The S&P is likely to finish the month still up about 16% for the year to date. And I think that's interesting because it really sets up October. October is the month that historically has had the most volatility events, stock market crashes. It's been a very volatile month, and I think that's what we're setting up to see here again. And you can do your own list of events that are coming up. We've got the silly debt ceiling. Silly, I say, because there's really no reason that the U.S. has a debt ceiling. It's a historical artifact left over from World War I. We've got the Fed saying that it's going to start tapering off its bond purchases in November. If that comes true, the market reacts to that. We've got rising bond yields, which is not a good thing for stock. We've got a real debt crisis in China. It's not just China Evergrande, but Goldman Sachs came out and noted that if you simply looked at borrowing by local government financing vehicles, if you look at the debt of all of these things connected to city and province government, it's about 60% of China's GDP. And if real estate prices fall, there's no way that this is a sustainable debt load. Huge problem, probably gets transferred back to the center, which is what's done in other crises. This would push down the yuan, except that the yuan is really tightly managed against the dollar. So with the dollar rising, the yuan has actually been rising too, despite all this stuff, which means that Chinese exports are getting a little more expensive in the world. So we're seeing a slowdown in the Chinese economy. All of that is not making the world feel very, very good about prospects for the third and the fourth quarter. So you've got all that stuff out there. One of the things we've learned is that the pandemic negative forces for the economy are not simply over, and they're not simply related to how many people are going to casinos, but the global supply chain is really broken. We've got whole industrial sectors like autos that can't get enough supplies, in this case chips. We've got whole countries where factories are running below capacity. China started, now we're adding Vietnam, Indonesia, Malaysia, big sources of things like shoes for Nike. Yesterday, Bed Bath & Beyond went out and said, hey, you know, we're looking at a really bigger than anticipated increase in our shipping costs, and it's coming right out of our profit margins. What they said is that originally for the quarter, they anticipated a 2.4% increase in shipping costs. That's across the ocean, across the country, whatever. And instead of 2.4%, they got 3.6%. About a 50% greater than expected cost increase. This is going to show up in third quarter earnings. Again, a reason to think that maybe the quarter will be volatile. One of the things we've learned from the September downturn is that, well, this is not going, if there is a sell-off in October, it's not going to happen across the board. Let's look at a couple of charts. Okay, this is a chart for the S&P. You can see the S&P hit its all-time high back on September 2nd. This is it. So we've been down pretty much since then, and here's where we are today. Okay, but if you look at, you compare that to the NASDAQ, looks pretty much the same, up patterns, but down from a high, well, actually a little later in September 7th, down further. But considering the fact that the S&P and the NASDAQ trade on different scales, this is actually a somewhat larger drop. And what we're seeing in the last week or so is that a lot of the drop is coming in big tech. That we're seeing a sell-off, that when investors wanted to raise cash, they decided, unlike in other sell-offs, that they would sell Amazon, Google. This is a chart for Amazon. You notice again, hits the high with the rest of the market, and then a couple bumps up, but then down fairly big. This is also the chart for Google, or Alphabet. Again, those two bumps, holding pretty steady, and then whoop, 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 and then this big drop here. So what we're seeing is that investors who want to raise cash look like, this time around, that they're raising cash in the technology sector. Is that the Russell 2000, the small cap index, which had been the most sensitive index to changes in market sentiment, up biggest on big days, down biggest on down days, and that still reacting very, very closely to changes in sentiment about the economy, but that the NASDAQ 100, this is the home of big cap tech stocks, has been actually moving in greater magnitude than the Russell. So it looks like this time that it's maybe a sell-off that may really affect the big stocks that no one wants to sell. They're very liquid, but I think what people are looking at is going, hey, these stocks are really, really, really at historical highs. And if we're looking at something like Amazon and looking at what looks like a pretty, what's the technical word for it? Oh, crappy holiday retail season, maybe Amazon is not a stock that we want to own, and other big tech stocks suffering from a lack of chips, et cetera, et cetera. All that seems to be saying, hey, let's sell tech this time first. Okay, that's what I've got on October, as we're just about to go into the month. So thanks you for watching. If you want to read more of my stuff, you can go to my free site, jubakpicks.com, down below. You can subscribe at jubakahem.com, which has got everything I write, 6 portfolios instead of 3. Link to that is down below. If you like this video, please like it, subscribe to my YouTube channel, and I'll see you again soon.